various elements of the financial statement, as well as how they are recognized and measured. Okay. Over the past 2 weeks, we have been looking at what accounting is all about, the profession, who the users of accounting information are, and what the reports are. Now, if I may ask, what is a financial statement, or who can help us with that? What is a financial statement? At least if you cannot define, you can describe. What is a financial statement? Selassie, what is a financial statement? Salamatu, what is a financial statement? Okay, Calvin, help us out.
Yes, a financial statement is a statement prepared to provide information showing the financial health position of a firm or business.
Okay, the financial health or position. Let's listen to Akosua.
Yeah, financial statements are formal record of a financial activity of a business, person, or other entity.
Hey, Akosua. This one is SHS definition. Yes, this one is SHS definition. That is not what we talked about. Okay, at this level, you must go above formal records. You haven't really said what it is. Okay, yes, it is a formal record, but what does it provide? What information? And so at this level, you are looking at adding more value to what you have read. But if you just say it's a formal record of, I don't even remember, then it's a bit questionable. Okay. Yes, Amos.
A financial statement is a statement prepared to provide information on the financial position, the financial performance, as well as the cash flow of a business.
Exactly. So this one is trying to describe the content. So if we say it is just providing records of information, yes, it is. But what kind of information would you find in there? And of course, I'm trying to clarify your point there. So you must let us know the content of a financial statement. In basic terms, I told you that it is the end product of the financial activities or transactions that have taken place over the period. Okay, it is a number of reports put together. These are the end products of the accounting process. Okay, and it provides information about the financial performance, financial position, cash flow. Okay, the notes of a business entity. And so I would prefer that one to yours, even though you have something in there. Okay, so we want to understand the components of financial statements. We are going a bit more in detail. We want to discuss the elements and look at the accounting equation, the effect of transaction, and also explain the concept of double entry. As usual, we have our reading list. Please refer to it for further clarification and understanding. And so, yes, we'll recall the components of financial statements. Okay, and then Samuel Edu, what are the components of financial statements? Samuel Edu. Yes, Isaac Robin.
Okay, Madam, we have the statement of financial position. And we
Yes.
have the income statement too, and the cash flow statement and notes to the account.
Okay, so we have these ones, and there is statement of changes in equity. So thank you, Isaac. So that is the component of financial statement. Okay, the income statement or the profit or loss account, the statement of financial position or the balance sheet. And you will recall that in our first lecture, we talked about the reports. So these are the varied reports that are generated, okay? Today, we want to delve a bit into it. And so we'll look at the kinds of financial statement. Last week, I mostly used the general purpose financial statement, largely because when you look at the conceptual framework, it allows us to provide information to a wide range of users, meaning that the financial statement as we have it, sorry, every user should be able to pick information sorry, that is required from the general purpose. And that is what we prepare. That doesn't mean that we cannot request for special financial statement. Okay, so if a user or some particular or group of users want some financials purposely to meet their decisions, they can also request, although it is much more costly if we have to do based on users' peculiar needs. So we'll look at the elements of the financial statements. Okay. So within the financial statement, you have the income, expenses, assets, liabilities, equities. Now, there are other elements that are not shown here, but these are the basic ones that you would find that applies to all the financial statement reports. Okay, these are the basic ones, or what we call the building blocks. Indeed, you would find these in two of the statements and not the others. But whatever it is, these information trickle down to the others, or the other statements that we have not, okay, also pick information from these elements, okay, to build their information as well. So they are the basic items or elements used in constructing these financial statements and around which, okay, transactions revolve. So all transactions could be categorized into one of these, okay, and that will come to play as we go along. Now, what are the elements? So we have the two which relate directly to performance, our financial performance. So you heard one of our colleagues, I think Kelvin, saying that it comprises of, or it provides information about financial performance. So if you want to assess the performance of a business entity, you would have to get information on income and expense in order to determine, okay, the performance of a business organization. But if you look at the arrow, you would see that the performance has an impact on the position. So how well, even if you relate it to your classwork, okay, in primary school, in secondary school, there were times when they were determining positions. And how well you perform will determine your position. If you do well in class in all your subjects, you expect to be perhaps between first and third. If your performance, some are not too good, some are very good, then you have a range. And so performance has a direct impact to your position. And in order to determine your financial position, you would have to pick information from assets, liabilities, and equity to determine your financial position. What then is your financial position? Everybody, like I did mention, position first, second, third, fourth. Again, your position in a particular, at a particular time may not be, you cannot maintain that position over time. Okay, the positions may change. And so when we come to financials, if today I own 2 vehicles at the close of today, 13th April, okay, captured in monetary terms, and tomorrow I sell off 1, by the close of tomorrow, my position would have been 2 vehicles. Would have been 1, sorry. But at the close of today, I had 2 vehicles in my business organization. And so it keeps changing through the assets, the liabilities, and the equity we encounter in the course of all the transactions that occur on a daily basis. And so your position, financial, in monetary terms, may change, okay, over time. So let's look at the components or the elements of these financials. The first one we'll look at is assets. Okay. Now, asset has been defined or described as a resource, okay, either controlled or owned by the business entity. That will generate some future economic benefits. So any resource that the business entity, remember, the business entity is a legal entity separate from the owners. So that legal entity having a resource, either through purchase, that is obtaining it, or controlling it, okay, based on some prior transactions. But what is the purpose of obtaining or controlling that resource? It is to be able to obtain some economic benefit. To be able to obtain some economic benefits. Okay, and that is what the standards or how the guidelines have described or defined assets. Okay, but in the layman's language, we normally refer to assets as the things or the resources that the business owns. Okay, do you recall substance over form? Which suggests that sometimes businesses don't only own resources, they can also control it, even though legally they do not own it. And so it is possible that even though you don't own it, meaning that the legal documents doesn't show the name of the business as owning that asset or that item, once you control it, okay, you can also regard it as an asset. You can also regard it as an asset. So that is it. So despite some text will tell you anything you own, but in current times, it has been expanded to include things you control largely. Okay, things you control or resources that you control. So the question is, can we say that human resource is an asset? Employees. Are employees assets of a business? Who can help us with that? Yes, Philip.
Yes, I think employees are assets of a business.
Why?
Because from the definition, it says there are probable future benefits, and employees, whether for the short term or long term, provide economic benefits to the company in terms of their working, which generates profits in the long run and in the short run for the company or business.
But Philip, if I may ask, is there a future economic benefit from employees?
Yes, I believe so.
You should. Okay, I think Calvin's hand is up.
Yes, I believe.
Calvin,
I believe they are assets because they are controlled or by management, and their output directly affects production, which in turn fetch revenue for their business.
so, just a minute, class. Some students who have just walked in. Let me see what they want so that I can sack them. So think through it and we'll discuss it. On whether employees are assets. Yes. Calvin, what were you saying?
Yes, madam, I was saying that they are assets because, first of all, they are controlled by management, and their output affects production directly, which in turn fetches revenue for the company. And so the economic benefit that it generates is the cash revenue from the product, from the produce or the products they produce or the service they render.
Okay, that is Calvin. I've seen Selassie's hand up. Selassie.
I don't believe employees are assets to the organization. This is because you would have to pay these employees when they work for you. So this brings extra expense to the organization. So I don't think employees are assets.
Okay, it's getting interesting. Any other? Manasseh. Yes.
So I think with what the other guys, I think what you said with the assets being, with the employees being paid, that assets are also depreciated, but they also, they are also in the form of expense to the company.
Okay, let's hear Godfred. Godfred, let's listen to your view.
Hello?
Yes, Godfred. Yeah.
Please, can you hear me?
Yes, we can hear you. Speak up.
Yeah, I absolutely disagree with the view that employees are assets of the company because they can be sacked at any time from the week. So I absolutely disagree. Even though they are the one that controls the work within the business environment. So I disagree with it.
Okay, so I can see a lot of hands up, but my view is that you may not be able to say that employees are assets. To some extent, it is the skills and expertise. And I've seen somebody put it in the chat that the skills and expertise, let me see, from Myanmar, yes, okay, the skills and expertise of employees is what businesses pay for. Now, look at the description of an asset. It must provide some future economic benefit. The question is, yes, we may control the employee today. Up until what point can you control an employee? And if an employee decides that I have gotten a new job, which is paying more, will that person still, okay, provide the future economic benefits that you expect? That is a question we must definitely be thinking about. Okay, so yes, up until the point where employees are working and remain in the business, their skills and expertise is what is used to generate that future economic benefit. However, in the future, is it possible that you can still, there's a probability that the future economic benefit will flow to the business? And so that is where the question is. And that definition does not suit employees as assets. Okay, somebody asked me in the earlier class, so madam, if I sign a contract to work for 5 years, and I said, no, even if you sign a contract, that contract does not say that you can never, ever leave after 5 years. The contract would give you two ways. Either you are staying for 5 years or you pay in lieu of the 5 years. And that is how contracts work, okay? So if I, for instance, I am teaching now and I get a World Bank contract that is going to pay me 20,000 USD, and then I sit here and say, oh, I have a contract with the University of Ghana, I am gone. So where is the future economic benefits that will obtain from all my expertise? Are you okay? So, of course, that is the caveat. Even though you may control it for the time being, okay, the future is uncertain as to whether that employee will remain even till the month ends. It's another question. And so that economic resource, which we refer to as assets, may not include employees. Okay, despite we normally refer to as their assets, human resource is an asset. Yes, it is a skill and expertise of employees for the time being. Okay, but you don't expect that it will generate some future economic benefits if that employee decides to leave. Another thing I put to the question, are children assets? Are you assets to your parents? Are you assets to your parents or you are liabilities to your parents? Yes, Justice.
Madam, please, it depends on the circumstances that you are getting. Let's say, for now, they are paying your school fees. You may say you are a liability, but when you help them produce or make money, you are an asset.
Okay, so Justice thinks that when you start making money and you start giving your parents, then you're an asset. Magdalene.
Madam, I think
yes.
I think it depends on the parents, because some parents they see the children as an investment. So as they take them to school, after school they reap economic benefits when their children have to take care of them. But some parents just take their children to school because they want to give them education, because they've already made investments for themselves after their own. So they might not necessarily need their children at that point.
Yes, let me pick the last view from Lowell.
Okay, so madam, please, I think we are assets, because even assets such as a van, motor vehicle, they have these expenses like buying petrol, and sometimes they get spoiled, repairs and everything. So we, for instance, we are an asset. We'll be giving back to our parents in the near future. So for now, they are just incurring expenses, and in future are going to be of asset to them.
No, well, are you sure you are going to be giving your parents as they have sacrificed for you? Again, the issue there, okay, it's whether there's a lot of uncertainty, okay, and this is just by the way, but there's a lot of uncertainty to suggest that children are assets, though most parents, we use the word generically to say, oh, I'm investing in my children, they are my assets, they are my precious, that and that, okay? But if you look at the definition, for now, perhaps somebody will say they control us. But what is the probable future economic benefits to generate from you? Like our Magdalene said earlier on, for some, they have already made their investment, so they don't mind whether you bring it. Some will have money, they will not even mind their parents. So why would parents be banking their hopes that children are assets and so they must give back and must enjoy economic benefits? Nobody knows the future. There is a lot of uncertainty. When we talk about probability here, there is some level of certainty that whatever resource you have would rake in some economic benefit in the future. But with children, I think there's a lot of uncertainty. Some will get good jobs, others will be struggling. Some will make it and still not give. And so it is not, it's not certain, okay? But the definition of asset per the guideline makes some certainty, okay? The probable future benefit is, there is a level of certainty. So for instance, if you acquire a car, if you acquire an equipment, you expect that the equipment will generate some streams of revenue for you over a period of time. The same cannot be said of children because of the uncertain nature. We are all human, okay? And so there is some level of uncertainty. So that is just by the way. Let's continue. Unfortunately, I cannot take more, so if there are issues. Exactly, so some may die. So if you die, there is no way that economic future will come. If you haven't got a job, that economic future will not come. So that economic benefit, okay, so based on accounting perspective and the description of an asset, I don't think for us parents, children are assets to us, even though we use the word generally to refer to the fact that we have some people we can relate to as ours, okay? But from the accounting point of view, okay, we are not assets per the description here, okay? I also have my mother there, so that is why I'm saying we are not. Okay, so if we go back, we would realize, just a minute. Okay, so this is our whiteboard. And we have just realized that the financial statement is made up of some elements. The first one we'll talk about is the statement of financial position. Okay, and under the statement of financial position, can have assets. You can also have liabilities, and we can also have equity. Now we can come down further and also classify assets into what we call the current assets, and then we have the non-current assets. Okay, when we come to liability, we can equally have the current liability and what we'll call the non-current liability. Okay, then we can further break down equity into share capital and reserves, and then go further down. Okay, so that is how the structure is, and we can continue till we get to transactions. So we said that accounting was a process. So this one I have started with the end product and I'm building it down to the last one. Okay, so we can come to what current assets are, non-current assets, current liability, the equity. So if you want to draw, you can continue. It's just to show you the structure of what we are doing in terms of the reports that are generated. Unfortunately, we'll have to keep moving that way. So, current assets is the classification, okay, of assets. We already know that assets are resources from which economic benefit will flow, okay? So anytime the economic benefit will flow within the financial year, if you recall last week, we talked about the periodicity concept. We have what we call the periodicity concept, or the time interval that allows us to break, okay, our finances or our years into periods. And so any period, normally it is 1 year, 12 calendar months. Maximum should be 15, but normally it is recommended. So any inflow within the 12 months period, okay, that will not go beyond that, is referred to as a current asset. So any resource that will flow within the 12-month period. Now the intention is to turn that resource into cash. Okay, and we have examples of current assets. Now be mindful of the different terminologies there, because sometimes the text book you use may have alternative terminologies. So if you see inventories, is the same as stock. If you see trade receivables, is the same as debtors. Okay, so stock is just your ordinary course of business. What is your what activity do you engage in? For instance, if you take Coca-Cola, their core activity is to produce drinks, okay? Drinks, and that becomes their stock. So their stock or their inventory would be the quantities of drinks that is available to the extent that you can always go and buy, okay? And that will be quantified. So if it is a wholesale business, then they will go and buy and come and put it in their warehouse, and that is also stock, okay? Now the expectation is that you don't expect to keep Coca-Cola or water for more than a year. The expectation is that you expect that within a short period of time you sell, go and buy another quantity, come and put in the warehouse, sell, and that is your normal activity, okay? Your stock in trade. Trade debtors, normally when you sell your stock, it's not everybody who pays in cash. There are instances where it is not paid in cash. And so where your customers fail to pay in cash, then you show it on your financials as debtors or receivables. It means you are expecting to receive that amount from your customers in the near future. Within the 1 year, you expect to receive the amount because they owe you, okay? In other times too, some customers would also have paid in advance before they even pick the product, or they want to deposit the money, okay? And I cite the example of your school fees. Some of you may have even paid for the whole year. In that instance, the University of Ghana cannot, okay, will capture that as a prepayment. You have paid before, okay, the rendering of the service or the product being sold to you. You have paid in advance, and that is also allowed, okay? Then we also have bank and cash, physical cash. So these things, as the name suggests, are current. And so anytime you hear current in accounting, it just refers to a period which is not more than a financial year or a year, okay, expecting that these things will change into cash within the period. Now for non-current assets, they are supposed to bring some benefits in more than a year, okay, in more than a year. And so it's supposed to be working and bringing in, generating some benefits, economic benefits for the business entity in more than a year. And so that is where the caveat is, okay? Whether you can classify employees, which of course they are the intangibles, okay? So examples of the non-current assets include land and building, okay, plant and machinery, motor vehicles, fixtures and fittings. If you look at it, these are tangible things or items that the business would use to work to be able to generate some revenue, okay? Whilst for goodwill is just as a result of your good name or your product, which is good, and people are banking their hopes on it. And so it is an intangible asset. Okay, you cannot touch goodwill, you cannot see it, okay? So we refer to it as intangible. The others are things that will generate the future. And so one of the characteristics of non-current asset is that it is not acquired for resale. Justice.
Madam, please, the account receivables are the
Justice, your line is not clear. Please come again.
Money that, let's say, please, can you hear me now?
Yeah, Justice,
Madam,
speak
please,
up.
can you hear me now?
Yes.
Yeah, I said the account receivables or the repayments. Let's say taking UG into consideration, the account receivables, are they the ones, like the expenses they paid in advance, or the prepaid, let's say light, for example, the electricity bill? Are they the bills that they pay in advance, or the school fees that students pay in advance?
Yes, and yes, once you have to pay and you pay in advance, that is prepayment.
Yeah.
If I got you right, because your line is still not clear, perhaps you may want to type it so that I can get what you mean. Okay, but I only heard electricity bill. Yes, if you pay electricity, for instance, so that is another example. Okay, most now prepayments, okay, where we pay electricity way ahead of usage. Okay, and that's why I suggested your school fees as well. So if you are paying your electricity bill and we are in April and you bought the credit or whatever for 1st April for the whole month, then up to now, today is 13th, the next 17 days, you can capture it as a prepayment in your records. Yes, Musa. Yes, Musa. Godfred.
I wanted to ask if non-current assets, can they be referred to as fixed asset?
Can non-current asset be what?
Referred to as fixed asset.
I don't want to use the term fixed assets because the non-current assets include others that are not fixed. Okay, so though you would see in some textbooks as fixed assets, but they are not current because their usage is expected to span more than one financial year. Okay, so yes, they are fixed, but it's not all that are fixed, and it's not all that are tangible. So we are mindful of the terminologies and the guidance. Every now and then, the terminologies are changing in line with current trends. Okay, I know in the past we used to refer to them as fixed assets. Okay, but in recent times, that terminology has changed. So partially, yes, but let's be abreast with terms in the profession.
Okay. Thank you.
Yes, Florence.
Madam, please, can copyright be termed as a non-current asset?
Yes, so if you can value it, the issue is about valuing it.
Okay, thank you.
Yeah, so it will fall under intangible. Justice, I hope you have typed your issue.
Madam, please, I've gotten you. I understood.
Okay, so somebody is asking, how can we value goodwill? Now, for those of you who will continue into the future, level 300 and 400 will teach you how to value goodwill. For now, let's be mindful of our friends who have never or have not done that. Okay, so yes, goodwill can be valued at a point in time, but not when your own business you cannot value. The only point you can value goodwill is when you are selling it. So the difference between your selling price and the value of the assets becomes your goodwill. And that is how we measure it. Okay, but you cannot be doing business and be saying that I have goodwill. Yes, Stephen. Yes, it is you, the students, who record it as prepayments. Okay, and the university will record it as a liability. So I think that was a correction. Yeah, I agree. I think I said the university, so that's. Any other? Yes, Justice.
I don't have any question.
Okay. Okay, thank you. So that is the classification for assets. Then we also have liabilities. Okay, so we have learned that an asset is any resource that can bring in some future benefit. And that transaction about that resource would have happened in the past, that event. Now, a liability is a present obligation, so you are obliged to pay. Okay, and that obligation would result in some sacrifices of that economic benefit, because you have a present obligation. Now, that obligation also resulted from a past event or transaction.
Hello, madam.
So every now and then, events and transactions. Yes, Ben.
Madam, please, I think Zoom has this problem where I think if you log out and you try logging in again, it takes you to another room. I don't know how to classify it, but then it takes you for, like, it doesn't allow you to join the class again. It takes you to another room. And it's happening to some students right now. And yesterday, it happened to me in my commercial law class. I was thinking it was the lecturer who kicked me out, but then today, some students are also facing the same challenge with the accounting class too.
Yeah, so the students must behave when they come. Unfortunately, there is, I don't know what I can do about that. Because I don't think I have logged the meeting. Okay, we will have to look out for that. Let me see. Okay, so now it says I have logged the meeting, no one else can join. So maybe let me see if I can unlock the meeting. So liabilities, we are saying that they are, okay, they are sacrifices the entity has to make in future based on some obligations they have today. Okay, and that will result in the transfer of an asset, okay, or some sacrifice of an economic benefit. Now that is the description of a liability. It's an amount you have to pay. In its basic explanation, it is what the business entity owes to third parties. So as a separate legal entity, we have said that it can transact businesses on its own. Okay, so when it transacts businesses, sometimes it doesn't pay outright. And so when you don't pay outright, then you have an obligation that you will pay in future. Okay, so it is a present obligation because the transaction has occurred, it is still staring in your face because you are yet to pay. And it will result in some future sacrifices, okay, or outflow of the economic benefits. And that is a liability. Okay, so now we can classify liabilities into two: the current liability and the non-current liability. Again, like we indicated for the assets, current liabilities are those that can be settled or those that are required to be settled within the 12 months period or within the reporting period. Okay. There again, you have the examples there: trade payables. So business entities also engage in transactions. They have suppliers. And anytime they buy from suppliers and don't pay immediately, the suppliers can treat them, or in the books of the business, they will record what we call a trade payable. And as you are yet to pay, and that supplier is a creditor. Okay, so you can have accounts payable or accruals where you are accruing your amount outstanding. And so we can accrue water bill. You realize that most often as individuals at home, we pay the water bill at the end of a period, not at the beginning. And so that figure unpaid, we can accrue it. We can gather it and pay later. Okay, we also have bank overdrafts, which is where the banks allow business entities to go beyond the money balance on their bank statement, okay? And there has to be some agreement to allow businesses to do that. So you can overdraw on your bank balance, okay? But the issue is that because it is current, it means within the financial year, you must be paying back and be overdrawing. So sometimes you can go beyond 5,000, you can go beyond 10,000. So it doesn't have to be stationary. Okay, fixed figure, always withdrawing, no. Then we also have the short-term loans. Okay, that suggests that within 12 months, you have to pay back. That is a loan. Okay, so once it's a current liability, then within 12 months, okay, you must convert it by paying cash. Okay, then the non-current liabilities are expected to be settled in more than a reporting period. Okay, beyond a reporting period, and they may include your long-term loans, your debentures, your bonds. Okay, so if you go for a loan and the bank tells you 2-3 years, that will be captured under a non-current liability. Yes, accrual is the same as owings, okay? These are just terminologies that are used. Can a liability be the same as an expense? For purposes of our work, liabilities are expenses result from or an increase in expense will have an impact on your liability. So they are not the same, okay? An increase in expenditure will have an impact, but they are not the same. You cannot equate it to be the same. Now, the third item is equity or net assets. Now, in business, it is somebody who must make the business functional. Once you have registered the business as a separate legal entity, you must note that that business cannot function unless somebody. So let's assume that group 7, account 7 is the business name. If everybody contributes to the functioning of the business to enable the business operate, then that will be stated capital or share capital. It is the owner's contribution. And that contribution could be cash, it could be assets, or any other form of contribution. Aside that, you may also have some surpluses. At the inception of any business, it is the owners who have to contribute to the business. But as you go along, you realize that the business is performing well. Anytime the business is performing well, you expect that at the end of every period, they should retain some of the earnings they have gained, okay? And that is retained earnings or income surplus. The surplus of the income after they've taken out all expenses. And that would also be part of your equity. Why? Because the business is owned by shareholders, and so everything after paying the liabilities, the obligations should automatically go to shareholders. That is the idea, because shareholders or the owners brought in money to establish and to make the business functional. Along the way, third parties who we are referring to as liabilities may also contribute in various ways. But anytime the business wants to liquidate or wants to shut, it would have to pay these third parties before whatever is left goes to the owners. Okay, so when you see equity or net assets, it refers to the assets of the business minus or after paying the liabilities, those obligations. Whatever is left belongs to the owners, and that is what we refer to as the net of the assets. Okay. When we talk about equity, it is made up of the stated capital or the contributions of the owners plus surpluses from having performed well. And there are other reserves, other times, some figures that pop up, and we put it as other reserves. Okay, as we go along, we will get to understand. Somebody wants to know the difference between a loan and an overdraft. Of course, these things are just terminologies. The only thing is that they have different characteristics. Okay, and so a loan can be short-term or long-term. That one, you go to the bank or you go to the financial institution and they give you a specified amount of money for a period with certain terms and conditions. With an overdraft, the characteristics or features of an overdraft allows you to withdraw beyond the amount of money you have on your financial state, on your bank balance, sorry. So if your bank balance has 5,000 and you need money to do something quickly and return it, the bank can allow you to withdraw up to 7,000. The extra 2,000 is what we refer to as the overdraft. You have overdrawn on your bank balance, okay? The idea is that in the short term, you are going to, maybe you are hard pressed. So you are going to clear some goods at the harbor. You don't have money. The bank can give you an overdraft to clear it. You sell the goods and you pay. So it is within the short time. So yes, they are all forms of loans, but they have different features and characteristics. And that's one thing you must note. The other element of the financial statement is income. Okay, so income can occur in the form of either an increase in an asset or reduction in your liability. So anytime your economic benefit goes up, it only suggests that you are raking in more money. That economic benefit you are deriving is coming in more. On the other hand, when you don't have an obligation, or you are reducing your obligation, then you don't have money to give out there. So it becomes part of what belongs to the entity. Okay, it becomes part of your revenue, because anytime you have a liability, it is an obligation you must fulfill. But if you don't have an obligation to fulfill, that economic benefit remains in the entity. And that is why we say a reduction in liability could also suggest an income to the entity. Okay. Now there are two classifications of income. It could be revenue or it could be gains. Now revenue is income that is obtained from your core business activity. So I cited an example of Coca-Cola. So if Coca-Cola's core business activity is manufacturing drinks, products, okay, with a label Coca-Cola products, then any amount raised from that sale of those products would be revenue. Now, Coca-Cola may be also doing other things at the side, which are not part of the main operations. And that may be gains. So if Coca-Cola decides to sell its trucks, that it's not part of the main core business of Coca-Cola. And that will be reported as a gain rather than revenue. Okay. So that is what it is. Then we have expenses. So Magdalene, a credit card does not necessarily allow you to go beyond your balance on the bank. A credit card only allows you to hold some money or allow you to have access to your funds through the card. Okay, it is rather a debit card. Okay, so it is not everybody that a credit card will allow you to overdraw. These are all negotiations that you have to have with the bank. And so don't assume that an overdraft works like a credit card, no. Okay. Yes, so overdrafts are only given to account holders of banks, not specific banks. So once you have an agreement with the bank to overdraw your account, and it is only on account, okay? It is a loan, but it is only given when you have an account there, because it allows you to go beyond the balance on your bank account. Somebody wants to know where gift will fall. Is the gift of the core business, okay? Is the gift part of the core business? And who is the gift to? Is it to the business organization or to the manager? That is a question you must ask yourself. Okay, in all these, one thing you must note is that everything you do, you must relate it to the business. So if the gift is to the business, then that is not part of the core activity. So you would have to look at where to place it. Okay. You may treat it as another income with a different name. Okay, and there's guidance on that. So expenses are decreases in economic benefit, but they are not. I think somebody asked whether expenses are equal to liabilities, and I said no. So either your economic benefit that you expect to obtain has declined. Why? Because you are engaging in some present obligation. So expense will lead you into liabilities, but it is not, okay? So expenses occurs when there is an outflow of your economic benefit, when it is reducing, or when you are incurring some obligations that you have to pay, it will result in an expense, okay? So invariably, once you have an expense, which is decreasing your economic benefit, then you should know that your equity is also declining, okay? Because now, if your assets are declining, your equity will be the next thing that will be affected, okay, in order to clear the present obligation. Mm-hmm. With respect to expenses, we have expenses and losses. An expense leads to a decrease in the economic benefit and a decline in your equity. Okay, let us again note that expenses occur in the normal course of business. So anything you would incur, transportation, water, telephone bills, these are just outflows from your economic benefit to achieve a business objective, and that is an expense. When it is a loss, if you go and invest in another entity and you don't do well, okay, that will become a loss. So losses arise from peripheral activities, other related activities that the business may engage in. So for instance, the business can decide to sell its assets after it has used it for a while. If it does not meet or the what is generating from that sale, okay, is less than the cost, then you say that there is a loss on disposal of the asset. It means the amount you disposed it of vis-a-vis the balance standing on your financials, there is a decline. So that is an outflow of your economic resources. So that can be classified as a loss. Now let's look at recognition and measurement. When we're looking at the framework last week, we looked at the users, we talked about the financial reports, and that's what we have just done, the component. It was described in the framework. We looked at the reports that are generated. We looked at the qualitative characteristics. One thing we didn't look at in the framework was recognition and measurement of elements in the financial statement. And so that is what we intend to do now. So what is recognition? When we talk about recognition in accounting, it's just a process of including in the financial statement items that meet the definition of the elements. Okay. Depreciation, Emmanuel Danso, is an expense, it's not a loss. Okay. So recognition, okay, is just the process, how we go about determining which element of the financial or which transaction, okay, meets the definition, and how to classify those transactions or arrange them according to the elements, okay? So that is recognition. Now, so these are the criteria. This is the criteria for recognizing items in the financial statement. The first one is the definition. So anytime you have a transaction, you have to ask yourself, which of the definitions does the transaction relate to or is more applicable? How can I measure in monetary terms the value of that transaction? I already did indicate to you that anything that cannot be quantified in monetary terms cannot be recognized. And so we must talk about the measurability. We have already seen these two words, relevance and reliability. Okay, you expect that relevancy to make a difference to the decision that somebody is making. Okay, and the information represents or has been recorded as it happened. And so the characteristics are here. Okay, the definition, we have already looked at them. Asset is a probable resource, a resource that would bring in economic benefit as a result of a past event. Liability, a present obligation, as a result of a past event, which will result in outflow of the economic resources. Okay, so to be able to recognize an asset, you must determine whether there's a probable future economic benefit. Okay, so aside the control or the ownership, this is very key. There should be a probable future economic benefit. And so if you go back to all the things we described when we're talking about asset, you ask yourself, is there a probable future economic benefit with respect to human resource? And so that should be your defining criteria to record it in the books. Then the second one, the item can be valued. You can assign a figure, okay, in monetary terms to it reliably. Okay, reliably, then that makes it an asset. Then you classify that item as an asset. When it's a liability, there must be a probable outflow of resources. Okay, there should be an outflow of resources from a present obligation, okay, or based on you trying to settle an obligation. Okay, that settlement will result in some outflow of resources. Here again, it must be measured in monetary terms to be able to meet the criteria. Okay, with income, anytime you have increases in economic benefits related to an increase in an asset or a liability, or a decrease in a liability, which can be measured. So once you have increases in the economic benefits as a result of some increase in an asset, then that is referred to as income. Changes in assets. Hello?
Hi.
Hi.
Okay. My internet dropped. I thought my internet dropped, so I
Hi.
it has
Hi.
affected you. This is in economic benefits. Okay, in the future, then that is an income. Or your liability. Remember, we have said that liabilities are present obligations. Okay, so when you have a present obligation that you can measure reliably, okay, but that has gone down. So you had an obligation yesterday, but by close of today, it has decreased. Then that difference becomes an income to you. Okay. Again, with respect to expense, when you have a decrease in that future economic benefit, that revenue that is coming in, when you use the Uber, that money that is coming in, if you have to buy fuel, then there's a decrease in that future economic benefit. If tomorrow morning you have to buy fuel into that car, it is that cost of fuel is an expense, and it has resulted or occurred as a result of a decrease in that economic benefit, which is the cash you're expecting to receive if you undertake that Uber business, okay? Or an increase in a liability. So an increase in a liability suggests that, yes, you want to buy fuel, they've given it to you to pay later. So once you have been asked to pay later, it only suggests that your debt outside is increasing. Okay, your debt outside is increasing, or your obligation is increasing because you have failed to pay immediately. Now let's look at how to measure. I've already told you that measurement has to do with monetary value, placing a monetary amount. And if you recall the money measurement concept, it requires businesses to put money value on the transactions. Okay, so you must put money value on the transactions to be able to record them. What money value can we put on some of the transactions? The first one is the historical cost concept. Ohene, what is the historical cost concept? Ohene.
Madam.
What is the historical cost concept?
Yes, madam. The historical cost concept has to be with showing expenses and then revenue as the cost it was incurred. Cost at the time, cost of acquisition, rather.
You are reading, you are reading from me.
No, madam, I'm not reading from the book. No,
okay,
madam.
so if we recall the historical cost concept last week, we would realize that the historical cost concept refers to the idea that businesses are allowed, okay, to show the cost of the item they purchased at the original cost on the face of it. So if you have your laptops and you bought it last year as a business entity and it cost you $1,000, if you are using dollar, you can keep the dollar on the face of it. That is if the dollar is your currency. If you are using cedis, at that day that you bought it, the exchange rate, you convert it and that becomes your acquisition cost. And that is what we refer to as your historical cost. I did mention that with historical cost, it is verifiable, okay? And it is an objective way because you have the receipt to prove that this is the amount you bought it or the invoice, okay? But there are other ways or other measurement types or bases that accountants can use, apart from the original cost. The other one is the current replacement cost. So what we will refer to in the local parlance as second-hand. So even with second-hand, if you go to first line, you have first selection and second selection. So that is the current replacement cost. How much would you incur in getting or acquiring a similar item in its current state? So if you bought your laptop and currently one of the letters are off, in that current state, if you go to the market and you were selling it off, or you go to a market that you have for laptops, how much would you be incurring to acquire such a laptop? Okay, it all depends on the market. So that is the current replacement cost. The challenge with that is that somebody can go in for first selection, which is higher. Somebody can go in for second selection, but they may all be in the same current state. Secondly, it depends on where you got it from. And so that becomes very subjective in accounting. And so though the guidelines always say that you can record your assets using the current replacement cost, okay, it is subjective. And it's a lot of work. It means you have to go find a market that sells these products in that state and determine how much it will cost and come and record it, okay, as the cost of the value. It means every time you have to be going, checking with the market. And so every year you would have to be replacing it. Yes, Paul.
Madam, please, when they say in that state, does it mean like even if it like you have to look for it? Let's say that you have a computer and then the keyboard is not working. So when they say in that state, does it mean that you have to look for a computer that the keyboard is not working and then you now search for the cost at that time? Or
exactly, Paul.
Okay.
Otherwise, how do you say it is in that state? That is the nature of your assets. So if you go and look for the cost of a laptop which keyboard is functioning well and place it as the value of your asset, whilst your value is not in that state, then what are we talking about? And that is why I said that the issue is that with the current replacement cost, it is more difficult and it is very subjective and allows accountants the leeway to record any value. But with the historical cost, you can verify where is the invoice, where is the receipt. So we say that the historical cost of measurement is the most objective way, okay, of recording assets and liabilities.
Thank you.
Are you okay?
Yes.
Yeah. Then we have the net realizable, okay? And this is mostly used to value stock, your inventory. Why? Because there are times when some of your inventories are becoming obsolete and you have to quickly dispose it off. And so in a bid to dispose it off, you will have to look for buyers or reduce the value in order to realize something out of it. And so the amount you would realize in the event that you disposed it off becomes the net realizable value. And so I cited the fact that if you hear ShopRite and all those shops doing sale, buy one, get 10 free. And it's not because you are so handsome or so beautiful. Sometimes it's because the goods are nearing expiration. And so in order not to incur that huge cost of expiring and throwing it away, they want to realize something out of it. So they reduce the prices just to get it cleared off their shelves. And that price that they will sell it off finally becomes the net realizable value. And like I said, it normally has to do with stock that are perishable okay, that has expiration. So if you hear all the ShopRite and the game and everything doing all their sales, sometimes it's because they have to realize an amount from it, okay, before it expires. And once it expires, you have to throw it off and write it off your books. So for prudence sake, you would want to get something small out of it. So that is it. The last one is normally used for projects where businesses have invested in projects. So for instance, the oil rig, we expect the oil rig to attract future cash flows. But if you expect 10,000 next year, time value of money, 10,000 next year is not 10,000 today. So you have to do what we call a discounting. You have to discount it based on an interest rate to the present value of the usage of the item in order to record it in the books. So these are all various monetary values that we can assign to assets and liabilities, depending on the policy of the business. You recall policies, okay, the specific rules you have chosen. So if you have chosen historical cost, that becomes your policy and you must follow through. Okay, that doesn't mean you cannot change. You can change it, but this year you cannot use historical cost. Next year you use current replacement. The next year you use historical no. You must follow through for a while. Okay, so these are ways that we can measure, we can assign some monetary values to assets and liabilities. Finally, we want to look at the double entry in accounting equation. And we know that businesses, okay, are set up. It's always based on an idea. Accounting equation is just a simple idea, okay, that financial accounting is based on, that the resources of a business, again, we go back to the business entity concepts, that separate legal entity, the resources it has in its own name, because it is an artificial person, it will definitely have been provided by somebody, okay? So who has claims over those resources? Yes, Benedicta. Benedicta. I'm saying that the discounted value is normally used where it is project. And so you expect a stream of cash flows into the future. But how do you record it today? Because remember, transactions that occur cannot wait. They must be recorded in the period to which they belong, the matching concept. So if you have incurred or you have entered into a contract today, or you have invested in the oil rig as an example, and there'll be future flows. For this year, how do you record the revenue associated with the cost? Okay, so whatever revenue you expect next year that relates to this year, you'd have to bring it back into the books. Because that cash will come next year, you have to discount it. That is an interest rate. For those of you who will be doing, I think all of you, about 300 finance, you learn more about discounting, okay? You'd have to assume 10,000 tomorrow, how much will it be today? Obviously, it's less than 10,000. The time value of money. Okay, money today, what money can do today, the same amount of money cannot do the same item next year around the same time. Okay, so how much money you expect to realize next year? In today's terms, it may be lower. That is just also a finance concept that you come to understand. Okay, so we say you discount it. It means you bring it into today's terms using an interest rate, and that's what I refer to. So let's get back to our accounting equation. And I'm saying that resources of a business would always be provided by some people. And those people will claim the resources of the business. Though once it moves to the business, it becomes that of the business. But the business is not a functional human being. It is people who do it. So people have claims over those resources. Okay. So the resources of a business are termed as assets. People who claim the resources of those business can be termed as liability. So that is another term we can use. So the resources of the business are known as assets. And that is why I said the basic definition would be resources that you own. Okay. That the business entity owns. When I say you own here, I'm referring to the business entity. The business entity owns as a separate legal entity. Now, who provided those resources to the business? Again, the business cannot function on its own because it is an artificial human being. And so definitely, some people may have to provide those resources for the business to call its own. Okay. And so liabilities could also be referred to as resources provided by outside parties or outsiders who are not part of the business, who are not the business. They could provide resources to the business, third parties, and they are known as liabilities. So that resource could be providing you with some goods on credit. So if you want to start a business, you have some money, you don't have all, somebody can offer you and say, look, go, let me give it to you. Go and sell and bring me back my money in a week's time. That period where you haven't paid, that quantity of goods that you can quantify is a liability over that period. Until you pay, it remains a liability to the business. So anytime a business goes to outside people, either to borrow money or to take goods with the intention of selling and paying back later, at the end of the financial year, if you have not paid, it is referred to as liabilities. Okay, and so the business will have to record it as such. Now, most often at the inception of every business, it is always the owners who provide those resources. So if you have your car, you have your cash, and you decide I've set up a business, Group 7 business entity. If you put that money into the business bank account, Group 7 business entity, bank account at StanChart, immediately that cash you have put in the Group 7 business entity becomes the asset of the business. But how do we show the owner's monetary value? Remember, we must measure the owner's value as well. And so whatever amount the owner brought will be recorded as owner's equity. And it will be equal to the amount that has been paid into the business bank account. Okay, so at inception, most often the asset is always equal to the owner's equity, or the resources of the business is provided by the owners. It's provided by the owners. Okay, and it's in the form of share capital or capital. Okay, and as the business grows over time, okay, where now it needs the support of third parties, they can also provide or add on to the resources of the business. And this is what we refer to as the accounting equation, where the resources of the business are either provided by the owner or by third parties. And the terminology we use is assets is equal to equity, okay, owner's equity plus the liabilities. So at every point in time, the assets should balance with it. So the business is balanced. On no occasion should the resources of the business be less than what the business owes. Then at that point, when the business has to wind up, what would the assets do? So that is the challenge. Okay. So every time it must. Now, so this is what we refer to as the accounting equation. And it's just based on the simple analogy that the resources of the business are provided by either the owners or third parties and nobody else. All other people will fall under third parties. If you give me any example, you can mention any name. We have grouped all of them as third parties and referring to them as liabilities. Okay, whilst the owners will be referred to as capital, okay, and they provide the resources for the business. Based on that, we are going to start our recording. The first one we want to look at, okay, is the fact that every transaction affects the accounting equation. Now we talked about the increases in income, increasing assets, and the increases in expense, increasing liabilities. So every transaction you have, you must identify which item of the financial statement it belongs to, and whether there will be an increase or there will be a decrease. And that is what we refer to as the effect of transaction. So the effect suggests that it is either increasing the assets, the liability or capital, or decreasing it. That is the terminology we use to show the effect on accounting equation. Now we all know the accounting equation. Basic, assets is equal to equity plus liabilities. And I guess we can all explain what that equation is. Okay, now let us look at how transactions affect the accounting equation. Of course, we are in level 200, and so we are going to start the recording process, but we can also go around it. Okay, again, let me refer you back to the definition of accounting. It is a process that seeks to record, measure. At least now we know measure. We know how to measure, putting a figure on it. So it will measure, it will summarize, it will categorize. But we can also have a transaction and just straight away. So we are going to go through the process gradually, but we also want to see the effect, the final effect on the reports that we generate. And that is what we are talking about here. So first and foremost, you'd have to identify the items involved in the transactions. Determine whether the item is an asset, a liability, or capital. Then you have to determine whether the item has increased or decreased, and by how much. Then you explain the effect on it. I would go with an example. So how do they change? Let us note that basically, anytime there is a transaction, then it will cause a change to these three items. It could be asset, it could be liability, it could be equity. Every transaction affects one or more of these components. And so you would have to figure out which one it affects, okay, and by how much. So if you look at the note, we say, okay, equity will be affected by additional contribution by owners, withdrawal by owners. If there is profit, that will go to equity. If there is a loss, okay, to go to expense. So you would have to determine which of these is affected, okay? In order to do that, accounting requires that these transactions are entered twice. And so we say it affects two items. So you would have to determine which two items, whether which asset item is affected, which liability item is affected, and whether it's affecting capital. That is one thing you must note. Okay, so accounting shows the effect of the transactions on these two items, whether it's an asset and the item either belonging to an asset, belonging to a liability, or belonging to capital. You must. We have already talked about some examples or all the items that could possibly fall under assets, under liability and capital. So you'd have to go through that again to just refresh your mind and then start the transaction. Now, because of the effects, okay, you would either have to be debiting or you have to be crediting. These are two terminologies students are always complaining about. Debit and credit, and sometimes it gets them all confused. Let me quickly try. So we have sorry, my line is not straight. I thought I was drawing. So this is what we have. And this is debit, short form, gosh. And this is credit on the right-hand side. It's always a credit entry. So sorry about my T. I think I didn't draw this one well. So that is what we have. And anytime, so we must learn this and understand it. Now let me go back. Every transaction must have a debit and a corresponding credit entry. That is a basic rule in accounting. That's what we refer to as the double entry principle. You enter the transactions twice. Why? Because the two items affected will have to show the effect of the transaction. So you enter it twice. Now, as a basic rule, these ones are basic rules you have to know. Anytime an asset is increasing, you debit it. I've already showed you the debit is always on the left, your left hand, that you will never go wrong. The credit is always on your right hand. So even if you forget anything, okay, you know that the debit is always on your left hand and the credit is always on your right hand. Okay, so anytime assets are increasing, in recording them, you'd have to debit it. Anytime the asset is decreasing, you credit it. In any transaction, anytime an expense is increasing, so the expense goes in line with assets, you debit it. If it is decreasing, you credit it. With liability, they go in line, liability, equity, and revenue. Anytime they are increasing, you rather credit it. And anytime they are decreasing, you debit it. These are rules of thumb that you ought to know. So, unfortunately, we are just about finishing. I'm going to give you, I think I've sent the first trial question. Go through, I think the last one, we will see some questions there on how to do the recording. In the meantime, let's use the next 2-3 minutes, okay, maximum 5 minutes to go through this as a way of examples. Okay, I guess you know what the elements of financial statements are, but more importantly, you should be able to show how the following transactions can affect the accounting equation. And if you are asked what the accounting equation is, you can straight away write it out and explain it in your own words. So let's look at the effect. purchase goods on credit. So let's assume Group 7, Account 7 entity or business organization purchased goods on credit from Ajua. What two items are affected? The question is, who is Ajua to the business entity? Yes, Isaac.
Ajua is a creditor to the business.
Yes, you have given us the terminology, but in basic language, Ajua is an outside party. And once we can identify Ajua as outside of the business entity, Ajua becomes what? A liability. Because we have said that all outside parties to the business will be classified as what? A liability. Are we okay? The question is, why would we bought from Ajua on credit? Anytime we buy on credit, it means that we are yet to pay Ajua. The year has ended. So Ajua will be a liability. What two items are affected? Yes, Florence.
Madam, please, asset and liability.
Please, that is not it. What asset in the name of what?
In the name of goods bought, and liability in the name of Ajua.
Exactly. So, yes, assets, goods. Goods, I've told you, whatever you trade in primarily becomes your stock in trade. So here we are assuming that once we are purchasing goods, that is what we trade in. So once we bring in goods into the business, those goods will be sold and generate the future what? Economic benefit. And that is why Florence said it is an asset. The question is will it cause an increase in assets or a decrease in assets? Kinsley. 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 Yes, Moses. Moses. Moses.
Please cause a decrease in assets.
It will cause a
decrease in assets.
Why do you think it will cause a decrease in assets, Moses? Yes, Moses. Janice. Janice, what do you think?
I think an increase in liability, and an increase in assets, because we
an increase in liability and an increase in assets. So Moses, Janice says it is an increase in asset and an increase in liability. Okay. Now the increase in assets is because you are taking the business. So it is the business that has brought in goods. So anytime the business buys goods, does the business own those goods? Yes. The answer is yes, because it has gone to Ajua and purchased it. The agreement is that I don't have money to pay now, so you give it to me, I'll pay later. Ajua has willingly agreed to give it to the business. So immediately the business purchased the goods, it means the goods are within the business. And that is an increase in assets. Remember inventory. Inventory is a current asset. So your number of goods have increased. And we say that anytime there is an increase in assets, you do what? You debit your accounts. So debit your purchases account. On the other hand, Ajua is a third party and we are yet to pay. So we capture Ajua's as what? A liability. And we haven't paid, so there's an increase in liability. And so if we open Ajua's account, we would also credit liability in the name of Ajua. Okay. What I would want you to do is to go over this as a basis, try to understand it, look at the questions, On Thursday, you would spend the first few minutes looking at it, okay, and that begins the recording process. At this point, we may have to move faster, so please make sure you understand this concept before Thursday. Yes, I've seen 2 hands up. Paul? Yes, Paul. Paul?
Yeah, Madam, please, can there be a case where only one item is affected? Maybe let's take it, there's a transaction that you took money from, you took cash from the bank. How does it affect 2 items?
Paul, you have even answered yourself. You yourself said you took cash from the bank. Cash and bank are different things. From accounting perspective.
But it does that affect the liabilities or the equity?
What do you think it will affect, Paul?
Assets.
So what would happen to assets?
It will increase and decrease at the same time.
Exactly. So the two, you see, double entry, you don't go wrong. The business entity, went to the bank and took cash and is holding it. So once the balance at the bank is decreasing, which is still an asset, the cash in hand at the business office is increasing. So that is the business. And the 2 items are cash and bank. And these are 2 different items, even though it will all result in the same cash, just changing hands. But those are the items we are looking at. So that is it. Are you okay, Paul?
Yes, please.
Okay, any question? Okay, so this brings us to the end of this session. And just as we have done the first transaction, looking at the effect, students kindly go to the rest 3. On Thursday, we would go through it together, go through the trial questions I have also sent on this area. You will take, a few students will have to answer it just to give more clarification to it, and would move into recording. Justice, what is your question? Justice, what is your question? Okay, on that note, I wish you all the best.